Hello and welcome to Vertices. Every client we bring into Vertices, we try to schedule a half-hour meeting to go over a few things just to make sure that as we get to know one another over the next several months and years, we're speaking the same language. Accounting in and of itself is a set of language, and there's some things that we want to make sure that we understand one another when we're speaking. Some of the great things about accounting are the system is 7,000 years old, and as a 7,000-year-old system, we know that it stood the test of time. It's quality, it works well. Some of the issues are we've developed a lot of ways to call things different names that get a little confusing when we're trying to talk about revenues or profits or cash flow or things like that. So we usually try to schedule a half-hour meeting with our clients, bring them in and say, hey, here's how we see financials. This is how an accountant sees it. These are the things we want to explain to you so that we understand the differences, so that when we're speaking, we're talking the same language. At Vertices, we try to use a few particular terms and we try to keep those the same all the time. Most of you know what income is. Every business owner knows what income is. So income we talk about and we try to call that income or revenue. Revenue and income are the same thing to us. Where these terms get confusing from other sources is the very top line, which you will also call sales, is the only thing we're going to refer to as income or revenue. Other places in accounting will say you have income and then you have the cost of that income or cost of goods, and then you have gross profit. And gross profit starts to introduce a concept of profit to people. They're not sure, are we talking about bottom line profit or top line? What profit is that? And these are where terms get a little bit confusing. They can also call this gross revenue. Now it gets really confusing because I have revenue and profit, usually tops and bottoms. Now I have gross revenue or gross profit that are the same line. Then we have expenses. And then we have net profit, which is what we're used to in business world. We have sales or revenue, we have expenses, we have profit. But accountants in the accounting world from time to time will interchange these terms. So we want you to know from Vertices, when we say revenue, or when we say income, we're always talking top line. If we want to calculate cost of goods sold and gross profit, we will call it gross profit. Gross profit is the profit off of the sale of your main product before any other expenses are taken out. Then you're going to have expenses and net profit. When we talk about net profit with you, we mean bottom line, because that's business terminology and you're used to it, and the terms work great for us as well. The example of what cost of goods are, because that's not a concept that's always well known. If I were going to sell you this marker for $1, I first have to purchase the marker to be able to resell it. So the cost of this marker is my cost of goods. And the cost of a good is the total cost for me to get that marker, that item from wherever it is, to me and ready to sell. So if it cost me 40 cents to buy the marker, and it cost me another 10 cents to transport it here, the cost of the marker is 50 cents. And then I sell it to you for $1. The dollar is my sales or my revenue or my income. The cost of goods is 50 cents, so my gross profit is 50 cents. I haven't taken any other expenses out yet. That's just the very top profit minus the cost of the marker. So I know on the product I'm providing, am I even making money at that level? If I'm not making money at the net profit line, I got to start backing up and see, where was I making money? Where do I need to make adjustments? If I'm not making money at the net profit line, but I go to the gross profit line and I'm making really good profit, my problem is in the expense area. So we're going to talk a lot about expenses, and these are typically things that you can control. The number of people you have hired, marketing, how much you're spending on meals and entertainment. We can control those things. Gross cost of goods, we have a harder time controlling. Those are set by the market. If this costs 50 cents, it costs 50 cents. I might be able to buy somewhere else for 49 cents or get a better quality for 52 cents, but that's a really tight window because the market tends to set the price for cost of goods. So it's harder for me to adjust that. It's harder for me to adjust cost of goods, so I have to increase selling price or cut expenses are typically the way I increase net profit. So when we're speaking about your financials and we're talking about financial performance and results, we're going to talk about sales or revenue, the cost of those goods or sales or revenue, and then gross profit. Then we'll talk about expenses, then we'll talk about net profit. And once we have this conversation, people typically go, hey, I get that. That makes sense. So now we're speaking the same language. Accounting is not your checkbook. Your checkbook doesn't care where anything comes from and where anything goes. It just cares that you recorded it. You're going to say things like, hey, I got paid. And in your checkbook, you go $10,000. And you just write in there, $10,000. There's nothing else to do. We call that single entry accounting. So if you had a checkbook, you would have in and out. You say, I got $10,000 in. And I had $4,000 out. Where did the $10,000 come from? Don't care. Hit the bank, it's mine. Where'd the $4,000 go? Don't care, it's out of the bank, it's not mine. That's single entry accounting. The problem with that is it doesn't answer any questions of the source of those funds or the spend of those funds. Accounting is double entry. Every time you make an entry here, it has to have a corresponding entry somewhere else. If you said this is $10,000 in, did that come from revenue? Did that come from a loan? Did that come from equity? The owner? Did you put money in? Where did the $10,000 come from? That's how I fact check and find every dollar in a business and know where it came from and where it went to. It has to have an offsetting entry. This $10,000 came in from where? This $4,000 went out, who'd it go to? Expenses? Payroll? Did I pay back the loan? Did I pay the owner? Did somebody return revenue to me? They returned stuff and I had to give them a $4,000 credit. Where'd it go? So in accounting, we do everything double entry, which as you can see causes a lot of headaches because every time a dollar comes in, it's tracked twice. Every time it goes out, it's tracked twice. And everywhere it moves inside the company, it's tracked twice. So you're duplicating the number of entries for every dollar that moves through a business. That's why you pay us to take care of the headache because you don't want to mess with that. That's why for our services, the more money you bring in, the more we have to track, the higher the cost of services as an accounting firm. That is our product. We're counting and tracking your dollars everywhere it touches and bounces around inside the business. So we start with an understanding of terminology, the basic things we're going to talk about, and then we start to understand what the system of accounting means so that you know why we ask so damn many questions, because we really do. We have to know or we can't complete the accounting process and we can't give you financials because we don't know where the money came from. After that, we start talking about the most confusing thing for most business owners, and that's cash versus accrual accounting, or when do I recognize revenue and profit versus that's not what it looks like in my checkbook. Remember, checkbook single entry, we just put it in and it's there and it only happens when cash moves. For proper accounting, there are things we call triggers that we want to explain to you so that you can properly know how your business is performing. If you're going to get bank lending, if you're going to bring in outside investors, if you're going to do a capital raise later, or if you're going to try to sell the business, you have to know how the business is actually performing, not just how the cash is moving, and I'll explain that. We're going to start Bob's Lawn Mowing Company. So Bob's going to start mowing lawns in January, and he's going to mow yards in February, and he's going to mow yards in March, and in March, Bob's going to say mowing lawns sucks and he's going to quit the business. So we're going to have a 3-month business to learn the difference between cash and accrual accounting. In cash accounting, it's very simple. We record it when the cash moves. So when the cash hits your bank, revenue. When it leaves your bank, expense. And that's just how it works. And to business owners, because you're used to a checkbook, that makes sense. But as you're going to see, it doesn't tell me how the business is. It just tells me when the cash moved. So in cash basis, we're going to say revenue. We're going to keep this simple. Expense. Profit, and we're going to track when these come and go on a cash basis. Now we're a good lawn mowing company and we're new, so we got to give people a reason to go with this. So we're going to do something a lot of businesses do. I'm going to sell you my product, but give you 30 days to pay me back. Because I'm trying to get people to sign up with me, and that's a big incentive. If I can give somebody time to pay me back, is why we often do terms, I can sell more products. So in the first month of my business, I'm going to mow $100 worth of yards, but they don't have to pay me till February. So on a cash basis, I had zero revenue because I didn't get the money yet. However, when I went to the gas station to get gas, they don't let me pay them in 30 days. I have to pay that bill right now. So I've got $50 in expense. And at the end of month 1, I lost $50. Not a great start. If I were looking at that from a cash basis and a financial, I'm trying to give a bank to get a loan. They're going to say, why would I give you money? You don't have any money. You have negative money. The next month in February, I'm going to mow another $100 worth of yards. But I'm not going to get paid, but the money from January is going to come in. So I have $100 in revenue that got paid to me actually from January. I have $50 from this month's expenses, so I have a $50 profit. And the business owner's going to go, that's what I thought this business was. I knew it. There's my profit. To a bank, you've still made no money. Negative 50, positive 50, you have zero cash right now. In the third month, you're going to say, I hate this job. The cash and accrual cycle, to understand them, at the very beginning of a business and the very end of the business after we've completely closed it down, they'll equal the same. But in the middle, they may never match again. So we're going to say in March and forever, because we're closing the business, so they've got as long as they want to pay us the money, we're closing it. The February money came in March. The March money we're going to show coming in March because we closed the business that month. So we have $200 in revenue because everybody finally paid us. We still had $50 in March for the expenses that we had to incur to do the work. We have $150 in profit, and business owners will go, we're keeping it open. I knew it. There's money in here. I finally have $150 in profit. And the bank's going to say, you lost money, you made huge money. We have no idea what the next month is going to look like because we don't know what the hell you're doing because your money's bouncing all over the place. We can't give you a loan. You're going to say, why won't they give me a loan? I just made a massive amount of money. But you have to understand the cycle's about to start over again because you collected all your money in March because you were closing the business. Had you not closed the business, this 100 would have pushed over. You would have made $50 profit and you would be 50, negative 50, you'd be zero, now only positive 50. And it'd take a long time for you to start showing cash coming in. That's how the money flowed. But that's not how the business performed. The business performed $100 worth of work in January. It didn't record because the money didn't come in and we were cash basis. If we took this exact same example and we simply changed the method of accounting where we said we want to book the revenue when we earned it, whether we get paid or not, we know that money's coming in, we'll track that a different way. We would have said in January, we did $100 worth of work even though we didn't get paid. We had $50 worth of expense. We had a $50 in profit, and we would introduce a new financial called the balance sheet. And you're going to be familiar with this when I say it. On the balance sheet, we have accounts receivable of that $100. It's not in the bank yet, so I can't put it in the bank. So I put it in a place and save it and go, remember, somebody owes me this, so I remember to go get it. That's on the balance sheet and accounts receivable. The next month would look exactly the same. And then in AR, we would have had plus 100, minus 100, because this 100 would have been paid. This 100 would be charged on to the next month. It would still have a $100 balance. So the changes that are happening in cash are down there on the balance sheet where I can track and say, I've done the work, they still owe me money, and I can show the bank. The business is doing very steady, doing very well, because the next month would be exactly the same. And a bank looks at this, or an investor looks at this, or somebody you want to sell the business to looks at this and goes, I know exactly how this business works. It just makes 50% profit it's a good business. Very steady, very solid, very easy for me to invest in because I can see how the business is performing. This is called accrual-based accounting. The balance sheet is tracking the money coming in and going out. So on the balance sheet, I'll have my checking account and I'll have accounts receivable. And the first month, the checking account didn't get no money, but AR did. And the next month, AR put money in the checking account and more money went into AR as we keep pushing this cycle forward. And a business owner would say, this is a good business. My revenue cycle is different than my cash cycle, but it's a good business. I just need to keep going and I'll continue to make that money month over month over month over a year, which is why we own businesses a long time. If we set them up right and we track them right, they continue to return profit to us. That's their point. So that is the difference in accounting and in cash accounting and accrual-based accounting, is it tells me the true performance of the business, or it is just telling me when the dollars moved. The dollar moves don't tell me how the business operated, it just tells me when I got paid. The last thing we'll chat about to tie all of these things together is the purpose of a business. So we've talked about the accounting system and how we track. We've talked about some terminology, revenues and profits and net profits and expenses. We've shown you the two different cycles. These two cycles are able to generate this revenue and cover their costs and have profits based on one particular item, and that's an asset. The goal of business is profit, but profits come from assets. So when we start to talk about a business and how the business can stay in business a long time, we have to discuss assets. An asset is anything in the company that returns current or future value. So we're going to use the lawnmower example as an example. In order for me to mow lawns, I have to have something to mow the lawns with called an asset. It's a lawnmower. So I'm going to buy a lawnmower and it's going to say it cost me $500. I'm going to trade cash that is an asset for a lawnmower that is an asset, and that didn't hit my profit loss statement at all. I just took something on the balance sheet that was cash and gave it to somebody, and they gave me an asset worth the same amount, a lawnmower, that I have for $500 on the balance sheet. So I had an asset of 500, an asset of 0, and I flipped them. The balances didn't change at all. I still have a $500 worth of assets. What I have to be careful of in business is tracking the replacement cost of that lawnmower because it won't last forever. We do this through a method and a tracking called depreciation. If we think the lawnmower is going to last 5 years and we paid $500 for it, every year we're going to take $100 worth of value away from that asset and expense it on the profit loss as depreciation. We're using up this asset. The reason tracking that asset depreciation is important is because when I get toward the end of its life, I have to buy a new one, which means I need to be reserving cash to replace the asset, or finding a source of cash, lending, personal investment, bringing a partner into the business, having them invest so I can buy 2 lawnmowers. And I've doubled the size of the assets, which means I've doubled the size of the potential revenue. So assets are the basis of business, and it's very, very important that business owners understand that. And you're going to say, but I don't provide anything, I just provide a service. Then your people are your asset. When you are a service-based business like we are in accounting, I don't give you anything tangible. I give you the results based on work people do on my team to compile your financials and provide them to you so you have something to gauge your business on. So that person I invest in is my cost of good or my asset. So when I'm doing intangible services or something that I don't hand you physically, I may not have an asset on the balance sheet, but I'm tracking that expense of that asset every month on the profit loss as the cost of my people. I have to have these people, they're my assets, or I can't provide you a service. So you're always tracking assets. You always have assets, be it people, which we would call more intangible, or something solid like a pickup or a car or an airplane or a lawnmower, or the things that you use to produce your business. Quick 30-minute intro to Vertices is, hey, welcome to Vertices. Let's go over a few things to make sure that we're saying the same things, that we understand each other. Let's understand the cycle of accounting. Let's understand the 2 different types of accounting we're going to talk about. And let's understand how to set your business up to be able to return to you for a long, long time into the future. That basis is going to be, we talk about revenue being revenue top line only, gross profit being after the cost of the good or the people or the service, and net profit to the very bottom line, and what we can manipulate to help you make more money. We start to talk about the systems of accounting, cash basis versus accrual basis. We don't want you to be cash basis. You don't want to be cash basis because you don't know how the business is performing on a cash basis. You only know when the cash moved. We want you to be accrual because it reflects the actual business operations and performance. From that, we're going to be able to help you get set up for lending, investment, sales, things like that. And the last thing we talk a lot about are the assets, because the assets are the basis of business. If you don't have them, you don't have a business. The other important thing to know about assets is they wear out. And it's very important that you know that and that you track that so that you have the cash reserved to replace them and keep the business going in the future. People don't understand that an accounting degree, to get to a CPA level or level accounting, you're talking a master's degree. If you've done accounts payable, you're not an accountant. Accounts payable is the tiniest sliver of the overall accounting package. It would be the same thing as saying, hey, I breathe oxygen, I'm an astronaut. No, you breathe space, but you're not in space, the way we define it. And accounting is very much the same. It'd be the same thing as somebody saying, hey, I just got finished reading a great book about law, I'm a lawyer. Those things don't correlate, but in accounting, we tend to enforce less the restrictions of the use of terminology. So a lot of people put themselves out as accountants or even as bookkeepers, and people understand bookkeeping is a professional certification. You have to pass standards and testing to be a bookkeeper. But you can open up a bookkeeping company with no requirements whatsoever and start doing work for people and have none of the training or prerequisites to actually know what proper accounting and bookkeeping is. When you interview a firm, when you hire a firm, you should make sure that they have professional training, that they're staying current on their training and up to date on the tax codes, that they're properly accounting for your cash so that when it's reported, people understand it. When you turn in bad financials to an investor, they just walk away. They know. If they're investing, their job, or they have a trained professional to look at your financials and say, yes, I understand the business, I understand what they're doing, or that's a hot mess. We have no idea what's going on in that company. And that's what bad financials do. They write a bad story. Accounting's a business language. And if you speak bad language, you get dismissed before you even get in the door. Same thing happens at banks. We help companies get a lot of lent from banks by understanding what the bank needs to see. If your financials don't show that, you have no prayer of getting a bank to sign on with you. They can't. They're taking too much risk. They don't know what you're doing. They don't know what the business cycle is. They don't know if you're actually making money or losing money, if you're not accounting properly. Where does money come from? If you have opening balance equity on your balance sheet, you don't have proper accounting. Opening balance equity is a software default that says, we don't know where the hell this came from, just stick it in opening balance equity. That means an accountant's never gone over your books and said, that's wrong. This came from somewhere and it came from here. So those are some things to look for in your own business. They're things that you want to sign on with a good accounting firm to help you understand, because hopefully, if you're hiring an accounting firm, your intention is to run your business better, return a greater profit, and run it for a long time. Thanks for your time and welcome to Vertices.